77% of Americans feel anxious with their financial decisions. Personal finance impacts everything in our lives, and the sad reality is that it is not talked about in schools, and people don't find it comfortable to talk about it with their peers, colleagues, and friends. This video talks about the basics of personal finance. What should you be doing with your money when you get paid? What are the different type of investments you can put your money so that your money can work for you in the long run? And a check sheet that I like to look at to make sure I know what I'm doing with my personal finances. So what should you be doing when you get paid? Even before you get a paycheck, your taxes are deducted, and you can also put your pre-taxed money into retirement savings account. There are two types of retirement savings account. 401k. Employees can contribute a portion of their pre-tax income to the plan, and some employers actually also provide a matching contribution. Then we have an IRA, which is an individual retirement account. It is a personal retirement savings account that allows individuals to contribute a portion of their income on a pre-tax basis. So even before you get your money in your checking account, your taxes are deducted, and ideally, if an employer is matching a certain amount for your retirement, you should be taking advantage of that. So in your checking account, you are getting after-tax money. What should you be doing with it? So there is a rule, the 50-30-20 rule. 50% of it should be going towards your needs, which is mortgage, rent, utilities, insurance, groceries. Now, I do understand that this is not realistic for a lot of people. A lot of people are putting in almost 70% of their income towards needs. But this is a general financial rule. If you have 70% going towards your needs, one thing that you can do is look for additional ways to make income. You can do side hustles, take up another job, or maybe put money into yourself to attain a high value skill. For example, going to college to get a degree in computer science, engineering, anything STEM, and try to save your money. See where you can cut back. Those are the two main things that you can take action right now. You should definitely have more income than what you are spending. That is personal finance 101. If you are spending more money than you don't have, you are putting yourself into financial strain. Then 20% of it should be going into your savings account. You should have at least $2,000 in your savings account minimum. Because what will happen is, in case your car breaks down all of a sudden, if you don't have an emergency fund, you're going to be taking out money from your credit cards. Credit card interest rates are extremely high. You are looking at 15 to 20%. You are just putting yourself into more debt. At least have 20%. Build an emergency fund which covers 3 to 6 months of your expenses. You can put it in a high yield savings account. There are a bunch. Some examples are here. For your savings, you can also save for retirement. So you can put your money in a Roth IRA. A Roth IRA is a personal retirement savings account that allows individuals to contribute after tax dollars. Now, after that, we have 15% to pay off high interest debt. If you have a credit card, you should be paying that amount in full if you can. Ideally, you should not be spending any money that you do not have. So if you cannot afford that purse in a full amount, you should not be putting it on your credit card. And if you cannot afford it, that is a sign for you to work on making additional income because your expenses are just too high. What should you do if you are in debt? So there are two ways to tackle this. One is the snowball method and one is the avalanche method. So the debt with the smallest amount you are paying first, and you feel happy and you are getting instant gratification. So then you have the momentum to work towards paying off all your debt. So you start with the smallest amount first, working towards paying off the largest amount. The more mathematically better way is the debt avalanche, where you are paying off the debt with the highest interest rate first and then paying it down. If you have debt, all of that 15% should be going towards that first. And then the rest 15% should be going towards your wants. Phones, eating out, going out with your friends. And the most important is investments. 15% of it should be going towards investing. We have ETFs, mutual funds, individual stocks. You can also save up to buy real estate or invest in yourself and your business. One thing I would recommend if you have no debt whatsoever and you are living below your means is to automatically transfer 15% of your income to your investments, 20% for savings and having an emergency fund. And if you have an emergency fund which covers 3 to 6 months of your expenses, you should be investing as much as you possibly can, especially in today's 2023 environment when we're going into a recession. This is a high time for you to build wealth. The next phase of this video, we will be talking about different types of investments. You have made the decision to start investing. What are the different investment options? Where do you think you should put your money towards? So now you have a budget. You are trying to look for ways to make more income, investing in yourself. You have increased savings. Where should you be investing this money? There are so many different options to invest, and we will be going over some of them. This is a high-level view for each and every different investment option. First and foremost, or one of the best ways I would recommend a beginner to invest in, is ETFs. Exchange traded funds allow investors to buy stocks or bonds in a certain market segment at once. We will be going over what a bond is. Some segments include technology, currencies, gold, international, and bonds, which are US Treasuries. Some ETFs include SPY and VOO. They track the S&P 500 index, which is the top 500 publicly traded American companies. You can buy ETFs through brokerage accounts like Fidelity, Vanguard, TD Ameritrade. Next is mutual funds. So mutual funds allow investors to pool their money together and invest in a diverse portfolio. The main difference is that ETFs are traded like stocks, whereas mutual funds are bought from the company directly issuing these shares. ETFs, like stocks, when the market is open, their prices fluctuate continuously, whereas for mutual funds, they are priced daily based on their asset value. The third type of investment are bonds. So the investor basically gives their money to the government or a company, a loan, and receives regular interest payments and a promise to repay the principal. You can buy them via the issuer, which is the government or the company, or the brokerage account like TD Ameritrade. Fourth type of investment is stocks. So a stock basically represents a share of a company. When you buy a share of the company, you are a part owner of the company and potentially profit from the company's growth and success. You can buy stocks from brokerages like Fidelity, Vanguard, TD Ameritrade, etc. The fifth type of investment is real estate. Investing in real estate can provide both rental income and long-term appreciation. You have probably heard of house hacking, where you buy a house, you live in that house, but you also have other roommates and other people who are helping you pay the mortgage through their rent. So every month you actually have an additional income from owning real estate. The sixth one are REITs. So REITs are real estate investment funds. It's basically a company that owns and operates real estate properties. Investors can buy shares and receive dividends from the rental income and profits. REITs pay 90% of their profits back to their shareholders, which is a consistent form of dividend income. You can buy them via brokerage accounts. For a beginner, I would definitely recommend ETFs like SPY and VOO. The S&P 500 index has returned on average 8 to 10%. 90% of investors who invest via single stocks have not outperformed the S&P 500 index. So if you do not know how to invest, just open a brokerage account and buy SPY and VOO with your money. Lastly, let's talk about a personal finance 101 checklist. The first thing is for you to create a budget every month. Look at your finances, look at where you are spending your money, what you are doing with your money. I know it sounds tedious, but it is extremely important. A lot of times we just spend our money and forget about it. It happens very often, more likely than you think. You can use apps. There are so many ways to budget. You really don't have to hand budget yourself. Create a budget that works for you. I talked about the 50-20-30 rule, 50% for your needs. Now, this is not realistic. I totally understand. Create a budget and see what you're doing with your money. The goal is to increase your income, reduce your expenses, and increase your investments and savings. The 50-20-30 is just a general guide. Use the 50-20-30 rule as where you want to be. What steps do you have to take with your money to make sure you get there? For most people, it's just saving majority of your money, or another way is to increase your income. Main points to consider when creating your budget. Savings, you have to set a portion of your income for future expenses or emergencies. Savings or emergency funds, very important. At least have a minimum of $2,000 in your savings account at all times. Always pay off your credit card in full, or at least make the minimum payment. If you are buying things that you cannot afford with your debit card, you should not be putting it on your credit card. What I usually like to do, if I really want something, just think about it for 20 minutes. Will it change the impact of your life? If it yes, then maybe think about it. But if it's a no, which it is in most cases, you should not buy it. Next, let's talk about debt management. If you are in debt, you should try to pay it off as as much as possible. Reduce your expenses. Live on the bare minimum for at least 6 months and your life will change. You can start using the rest of your money for investments. You will build long-term wealth. Let's talk about retirement planning. You have to figure out how much money you are spending and how much money you would need to retire comfortably and start planning for that. You can use the rule of 25 as a guide. So for example, if you are spending $50,000 annually, you need to save 25 times that amount. So you would need $1.25 million to retire comfortably. Like mentioned earlier, there are 3 types of retirement accounts that you can take benefit of. 401k and IRA are retirement account where you can contribute pre-tax money. But the issue is when you do take the money out, you do have to pay taxes. So the better alternative is the Roth IRA, where you are putting in pre-tax dollars and you won't pay interest when you cash out. Please let me know your feedback or if you want a video on anything in particular, and I shall see you in the next one. Bye.